Yeah, trying to predict the Fed actions, and trying to predict where interest rates are going to go. It's like trying to predict where a stock's going to go. It's really challenging, and so it's better to be diversified across a variety of segments, just like with stocks. One reason the Fed has been able to increase interest rates and be pretty aggressive with it over the last year is that the jobs market's been really strong. Even the last data report that came out a week ago showed that the jobs market's still at unemployment rate around 3.6%. That's pretty low compared to long-term averages.
As far as the individual investor and individual consumer, what's their story?
Yeah, let's talk about that, because the consumer and consumption in our economy is a really big part of our overall economy. In fact, 70% of our economic activity is from consumption. So we pay close attention to what the consumer is doing. A couple different ways to look at that. One of them we look at, it's called the misery index. The misery index is the comparison of looking at the combination of CPI or inflation plus unemployment. So you glue together two kind of factors in the economy to see how are those things combined doing, because it kind of, the higher the number goes, generally the higher the misery people might be feeling. More unemployment and higher inflation, people tend to feel worse in that environment. What we find, which is maybe interesting to hear, is that the misery index shows us right now, this data goes back a long ways, right now it's registering at about 7.6 is the combined total of CPI, of inflation plus unemployment. The long-term average is about 9.2, meaning we're actually below, in terms of the misery index, we're actually below average.
We're saying there's the misery index, and then there's another index that we track for.
Yeah, consumer confidence is another indicator we follow. It's where it's a survey based on how individuals feel about their job, feel about their purchases, feel about savings. When it comes to consumer confidence, when the number is very low and people tend to feel their worst from a survey-based standpoint, the returns going forward on stock market actually tends to be quite strong. The last 12 months has been a great example where we bottomed out around June of last year, and that consumer confidence, and you look at the last 12 months, actually been pretty strong results this year including.
Let's talk about how consumers are saving and borrowing.
During the COVID time period, savings went up a lot. Given that people weren't spending as much, there was more stimulus in the economy being delivered. Now we're seeing it taper down to where savings is actually, this year we look at it's running about 4% year to date on a personal savings rate. That's below average. As inflation eats away at additional saving, right, that's generally the first place it comes from is your savings, right? The cost to, whether it's buying a home, whether it's buying food, energy prices as they fluctuate up and down, those things all impact the savings rate, and especially as inflation has generally gone higher in the last couple of years, that's a certain component, certainly a component where we've seen savings rates come down. In terms of spending that occurs in the U.S., net interest spending, it's about $640 billion this year. About 10% of our total spending is for net interest, the cost to finance our debt. That's not paying down principal, that's just the cost of the interest. Now that number has increased, partly because we've taken on more debt, but also more recently because interest rates are going higher. One of the items we're paying attention to, and I think we'll get more attention, is as we roll forward, if interest rates continue to stay at these levels, it's going to keep getting incrementally more expensive because we're constantly refinancing bonds, the Treasury is, at higher interest rates. And so it's getting more expensive, and such that net interest cost is likely to keep increasing even if we don't take on more debt, just because of the sheer cost of refinancing.
So this last quarter we saw the rise of the debt ceiling. Mm-hmm. How does that relate to federal budget?
Yeah, the lifting of the debt ceiling allowed for an increase in the amount of borrowings to operate the government. And so we now have an increase in the debt ceiling. It's been increased several times over the years. And what it does, it just allows for more debt to be borrowed, more borrowings to help operate the things that are committed as far as expenses, whether it's Social Security spending, Medicare, Medicaid, those programs where that spending has kind of already been earmarked, and now it's just raising the debt ceiling, the limit to borrow in order to kind of keep paying for those things. When we look at the yield curve, we're comparing the yield available on short-term bonds, Treasuries for example, compared to all the way up to longer-term bonds. So picture a 3-month Treasury bill, compare the yield on that all the way out to a 30-year Treasury bond. More recently, what's been happening, if we look at either this most recent data point or even rewind to last December, we have an inverted yield curve, meaning the yield available on short-term bonds is higher than the yield available on long-term bonds. That's unusual. We typically don't see that. There's some of a disconnect in the yield curve right now.
Does that mean that investors buying these treasuries are anticipating lower rates in the future?
It can mean a lot of things. In one sense, investors are crowding to the short-term part of the yield curve because they view the longer term as being too risky. If the view is that interest rates are going to keep going higher and higher, then they will maybe crowd to the shorter end part of the yield curve. Equally, or as the other thing that's occurring here too, is the Federal Reserve is raising interest rates, and that's the short end part. So the Federal Reserve is actively in the market raising the Fed funds rate. That's causing the short end part of the yield curve to go up, and that's been moving faster than the long-term part of the yield curve. So it hasn't kept up with it. And in a sense, investors have, in nominal terms, they've been rewarded by buying just short-term bonds, meaning right now you can get around 5% yield on pretty short-term bonds. In nominal, before we adjust for inflation, that doesn't seem too bad for a lot of cases. What we find is that U.S. stock market performed really quite well. It's up about 8.4% during the quarter. And then commodities, though, commodities is the one area where we saw negatives during the quarter. Commodities were down about 2.5%. That was on the heels of inflation starting to kind of roll over and come down more. Relatively sluggish for the U.S. bond market. It finished the quarter down about 0.84%. When you look at this chart, the weight of the top 10 stocks in the S&P 500, it currently makes up about almost 32% of the whole index. So I'll say that again, the top 10 companies, the weight of all those companies, you add it all up, it's about 32% of the index.
Wow.
That's a pretty high weight. As you can see from this chart, it's hitting near all-time highs. Now, the flip side, if we look at this next slide here, we look at the earnings contribution. What we find is that the earnings contribution of those top companies is about 22%. So if we kind of dissect that a little further, we find that the large companies make up a large weight, the top 10 companies. They're not pulling as much in terms of earnings. They're pulling a lot of the price performance, but not so much in the earnings. And that's something that we're aware of, we want to be mindful of, because either those companies' earnings have to catch up, or we might see some of those prices start to kind of top out.
Do you think that investors are going to look to other asset types?
Yeah, in fact, we've done some studies on this already where we look to see how smaller companies in the U.S. tend to perform when this occurs. Historically, it's actually favored smaller companies, which isn't too surprising. Markets go in kind of move in pendulum. Pendulum swings back and forth and they move in cycles. But what can happen is we can see a strong run-up in prices on a certain segment of the economy or the market, followed by what can be a shift to other types of companies being in favor. And that's where perhaps smaller U.S. companies may be more in the limelight going forward.